Welcome to our weekly Forex forecast. We'll also take a look at the gold market today. My name is Jay Norris. I'm a trading instructor at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for everybody. The first market we're going to take a look at will be the Australian US dollar. The Australian US dollar finally starting to break down. You could see it never could eclipse that 382 retracement line. So if you can't get through the 382, you're not even going to get close to that 50% retracement. We saw that is definitely a sign of weakness. Now you're seeing it break down. See that dark line right there? That marks the low of the highest closing candle in this previous uptrend. So that's a significant level. At that point, when the market closed at that high close, it was pretty strong, okay? When you close below the low of the highest closing candle, something's changed in the market. That's why we call this a change of direction candle, the candle that closes below that low. So as you saw, you started to see pretty good short selling opportunities Thursday and Friday. We think that'll continue into this week. So we definitely like the short side here in the Aussie. I think if you can chip it below 89 even, that'll really open up the door further on the downside, especially in the face of a weak US dollar at the tail end of last week. To have a weak Aussie too, that doesn't bode well. Next market will be the dollar Swiss, and here's where you really saw US dollar weakness. You know, we talked about this last week. We like short intraday and even as a swing trader now, still a little bit nervous about taking short positions here because you're right on top of that support, the 2013 low. A wise man once told me that support and resistance lines should be drawn with a crayon, not a sharp pencil. They tend to act as a band of support. So I know you had a weekly close below 88 even. I think that's significant, and you know, the more the market gets comfortable below that 88 even level, I know the market had to close below that 88 level, and I do think that's significant. So the more the market gets comfortable trading below that level, the more likely it is you'll see a continuation of lower prices. But for now, we're content to be working the short side, short term, not so sure about longer term positions just yet until you get more comfortable below that 88 even figure. If you do, you know, that potentially opens up the door to 85 even. I know that's a big drop, so we'll have to see. Next market will be the dollar index. I've been saying it for the past month or so. If you like that dollar index on the approach to 80 even, you got to love it. On the approach to 79 even, you still have pretty big support down here. So, you know, the dollar index, I understand all your shorter term patterns, most all your patterns here are down. Here's our RTT ratio. When you look at the dollar index, look at them. They're all aligned on the downside. However, you have that primary pattern, that long-term primary pattern support still up. Now, the only time long-term support is really significant is when you come up to it. If you're not near it, then it's not significant, right? So, you know, that's why I say 79 even is a big level. That's actually long-term primary pattern support. So the dollar index, similar to the dollar chief here, how we would view this, that, you know, as a position trader, longer term, you don't want to be short. If anything, you'd be eyeing that potentially in the low 79s for a long-term setup. On the other hand, short-term, short-term and intermediate term, you definitely be working the short side, selling rallies here. So dollar index, you're looking at both sides of that market. And here's the euro. The euro was given great buy setups on Friday. It was really a nice market to trade short-term. So again, as a short-term trader, as a swing trader, you're working the long side. Now, as a position trader, I can't get comfortable with a long position because you're nearly right on top of long-term resistance. Again, long-term resistance, it's only significant when you get there. It's only relevant when you're against it. If you're a long ways from it, then you know that's one thing to be buying dips in anticipation of a move towards resistance. Here, when you get that close to it, just don't know. You know, when you look at a weekly chart here, you start to see what could be a triple top or a big head and shoulders top, and I'm reminded that long-term primary pattern is still down. There's a Gann line, a 625. You can see price topped right on that 625 last time. Gann theory, well, Gann used to say that as long as you were below that 625, the market was still in a bear market. And that's how I view this too. And here's our RTT level just below the 140 level. For our money, as long as you're below that 140, this pattern is still bearish. As long as you're holding below those levels, it's a bearish pattern. So therefore, longer term, you'd still be looking for sell setups against these levels. Short term, it's a different story. Intraday, you've certainly been getting great buy signals, and we see no reason why we would stop buying dips as we have been short term. What's interesting too, what's playing into all this, I believe, is it's tax time. If you trade a LLC or you trade a S corp or any kind of corporate account, your taxes are due. So you're kind of in a funny position. You're sitting on cash to pay your taxes, right? Yet you're not going to pay them early. Yet at the same time, you don't want to get in a little bit of a drama. You don't want to get in a fight with a longer term position and be in a position where the market starts taking your tax money. So I really think you get past March 15th when the corporations have to pay their taxes, and I think it'll be a different market. I think traders will be more aggressive. For right now, I know myself, again, if you're sitting on the money to pay the taxes, you don't want to risk that money. And this is a risky market right now because it's pretty choppy. I mean, they could easily go out here and blow off stops. You get a run to 140, and that could be dangerous. Next market, the gold market. Gold, you're up against long-term resistance. Also, again, really the only time those longer-term patterns are relevant is when you're coming up on resistance and you're at it now. This GAN 625 line, then our RTT ratio is just above there. So gold, the bottom line is this big secondary move is still bearish as long as you're below resistance. Without a doubt, the long-term, your primary pattern is still down also. So gold against significant levels here. I think if you have exposure to gold, it may not be a bad idea to look at hedging in this area right here, right now, really. And I think that may be another one where the tax implications. If you've made gold, if you've made money long gold the last quarter, guess what? You're going to have your taxes due. So that may be a cause for profit taking along the way. So gold, we think, is in a vulnerable position up here. Last market we'll cover is dollar yen. Here's the dollar yen. We talked about this last week, where we wouldn't mind buying dips, but we wouldn't mind buying the big dip. Would love to see a retest of this 50% retracement level. That's, you take this low, that high, you take this big secondary move, and that purple line marks the 50% retracement of that. You look at your index, you look at our RTT ratio in dollar yen, and you can see this week you shifted that 5 and 10 day pattern down. The 25 day is up. The key to me is this long-term secondary pattern right there, and the long-term patterns overall. I mean, if you're a long-term position trader here, you're looking to buy a dip because all these long-term patterns are up still. So we'd love to see a dip down and give us a nice double bottom on that 50% level, or even run stops below there and get it close to par. You get a buy signal down there. We'd definitely be interested in that. But we like buying dips long term. We think from a position trader's perspective, that's still the way to go. Now, keep in mind, as a short-term trader, I like short-term trading because you get in and out and you sleep at night, right? Travel light, sleep at night. Don't carry positions when you're sleeping. And that's kind of the short-term trader's viewpoint, short-term trader mindset. I don't mind that. But back to the dollar yen, if you look at that 5 and 10 day are down, if you're a short-term trader, you just trade the 5, 10, and 25, then the majority of those patterns are down. So you're looking to sell rallies. But keep in mind, as I said before, short-term, long-term resistance is really only relevant when you get on top of it. So 101 is a big level here, and then par also, just above par. Always a pleasure. Thank you for coming and seeing us. Let me just leave you with this thought, that it is much easier to follow the path the market has laid out for us when we have no opinion. So lose your opinion, not your money. That's why we rely on that RTT ratio so much, because it's telling us the current patterns in the market, and it's directing us to trade along with those patterns. So it's not what we think the market's going to do. We take our cue from what the market is actually doing. We feel that what's happening right now in the market is most important of all. Thank you so much, and we'll see you next time.